Do you make too much money to fund retirement accounts? Which tax shelters are still available as your income goes up? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The U.S. is known for having the most complicated tax system on the entire planet Earth. It is. That's not, might sound like an opinion. Nope, that's the fact. It is the most complicated, despite both political parties talking about how they're going to make taxes easier. One even said you'll be able to do your taxes on a postcard. And then when they did that, they added a whole bunch of other schedules and additional pages. It's wildly complicated, guys. And it's not just the tax forms. The entire tax system is complicated. It's called a progressive tax system, and that's not a political term. Essentially what it means is as your income goes up, the tax rates go up as well. The tax goes up as well. And I know that probably stirs up a lot of emotion for folks with, celebrities or public figures that are known to have a lot of wealth. You might have heard claims that they pay very little in tax and all that sort of stuff. Well, some of those claims are accurate because the types of income that they have are pretty low. It's also accurate. I've done some videos on this before. Some folks that have significant wealth, they don't sell their assets and claim that as income. They borrow from them, and that's what they live on, and therefore there's not a lot of taxable income. And then others where it's just not true. Folks that are athletes or whatever. Lots of celebrities, they are paid normal type wages and pay a large amount of tax. And so anyway, cutting through all that emotion, we have a progressive tax system, which means the more income you make, the higher the tax bracket is. So all of your income minus your deductions, the first X amount is taxed at 10%, no matter who you are, whether you're a celebrity or not. The first X amount is taxed at 10% from that next tier. So from above that 10% to the top of the next threshold is taxed at 12%. Then it goes to 22, then 24, and so on. So everyone has a little bit at the 10%, and then if your income's above that, then the next chunk will be at 12, and then 22, then 24, and so on. So it sort of stair steps, okay? Also, as your income goes up, other taxes get introduced. The net investment income tax, income-related monthly adjustment amount, and IRMA, that's not an actual tax, but it increases what you pay for your Medicare, so it's like a tax. There is the additional Medicare tax. There's more taxes that are introduced. Tax deductions start going away. There's something called alternative minimum tax, AMT, so some deductions start going away as your income goes up. And then certain tax credits start going away completely. Some of you that own or run a small business, there's the qualified business income deduction that if your income's above a certain threshold and you're in certain industries, or certain professions, you start getting less and less of those of that deduction. You could make too much money where you no longer get a child tax credit. And so this progressive tax system, yes, the higher your wages are, those wages or that income is at a higher tax bracket, higher tax rate, but then you start losing some of the goodies. When it comes to saving up for retirement, if you've got high income, and I think this is more common, if you're making $1 million, a couple million every single year, then you're working with a CFP, you're exploring what options do you have available, and this content is very relevant to you. I think more common than that are the folks that maybe have good income and then due to some bonuses or some structured compensation, there's a few years where their income really spikes, okay? Because their business did really well or they received some sort of bonus package or some sort of benefit where for 3 years, maybe you make $400,000 a year and then for a few years, your income's at or near $1 million. Well, if that's you, how can you shelter? What options are available for you to shelter some of those dollars into the normal tax shelters that the rest of us get? Do you make too much for a Roth IRA, those sorts of things? What are your options to saving those dollars into tax sheltered accounts? No matter what your income, you can put money into, you can contribute, you can deposit into an individual account or a joint account. Those are not tax sheltered accounts. So if you're just thinking, well, I want to invest for my future, or I've made a lot of money and I want to set some aside, to invest in, you can always just put it in an individual account or a joint account. Hopefully, if you're married, I would add transfer on death, TOD, to those, or I'd put it in a trust account. Typically, that's going to make more sense for you. And those are not tax sheltered accounts. But the challenge is all of the dividends from those accounts are going to land on your tax returns, as well as capital gains. And if you say, well, I'm just buying individual stocks, I don't plan to sell, well, then there won't be any realized capital gains until you sell. But then you're in a tricky spot because you're never going to want to sell those investments. If they do well, that means there is a lot of capital gain, and that means you might have a more concentrated position in a stock that could leave you exposed. You've got more risk, but yet, even though you're taking more risk, you don't want to sell it because there's capital gains. So it creates this challenge. Therefore, now you're going to want to contribute to those. I'm sure you will, working with your CFP. But what tax shelters are available to you? The first is your 401k or workplace retirement plan. There is no income limit. There is no income limit to contributing to your 401k. If there is a company match and the 401k plan is not a safe harbor, then there may be a top heavy. That plan may be top heavy, and you may be limited on how much you're able to contribute. But it's not because, well, once your income exceeds $500,000 or $1 million or whatever, you can't contribute to the 401k. It's just a calculation that determines, based on all employees compared to highly comped employees, the highly comped employees can't contribute more than 2% more than the average employee. But a lot of laws or a lot of 401ks are shifting to safe harbor plans, so they can sort of not have to worry about that complicated contribution limit. Other than that unique circumstance, there's no income limit on contributing to your 401k. So even if you make $1 million, you can still contribute pre-tax to your 401k. Or if you'd prefer, and your 401k has a Roth feature, you can contribute to that Roth no matter how much you earn, Roth 401k. Along with that, if your 401k allows for after-tax contributions, you could do a mega backdoor Roth IRA, which I think that is hilarious. And I didn't come up with that term. We were doing these additional contributions after tax to your 401k when we were just calling them that. They didn't have a term, but now the industry has said mega backdoor Roth IRA. So what that is your 401k has the ability to allow you to contribute 3 different ways. The plan document can say, no, you're only allowed to contribute 2 ways or 1 way. It's up to your plan. But if your plan allows, you can contribute pre-tax, you can contribute Roth, which yes is after tax, but then all those the growth on the Roth dollars are tax-free, or you could also contribute after tax, which means you're not getting a deduction on your contribution, but the growth on those after-tax dollars will someday be taxable. So those are your 3 options if your 401k plan allows. And therefore, if you're high income, you're going to want to contribute the maximum amount to your regular 401k, pre-tax or Roth. But then if your plan allows for after-tax contributions, you'll want to contribute as much as you can after tax as well. And there's a higher limit. If right now the 401k contribution limit is $22,500 for all employees, if you're age 50 or more, there's another $7,500 that you could do. That's to either pre-tax or Roth. To after-tax contribution, it goes up to another limit, which is around $65,000, $66,000, depends on the year, of total contributions to your retirement plans, and that would include a company match. And so you're going to want to be aware of that. But even if you're highly comped, if you're making a large amount of income and those dollars, you can contribute an extra 20 grand or 30 grand after tax into your 401k. Yes, it doesn't help you on your taxes today, but then it allows those dollars to grow tax sheltered for, until you draw them out. It also opens the door for that mega backdoor Roth IRA where you can then take those after tax dollars that you contributed and convert them move them to your Roth IRA. It's not even a conversion. You can move them directly to your Roth IRA. And so work with your certified financial planner on that. But that is an opportunity for those of you that maybe have high income and are looking at saying, well, how can I shelter as much of this as possible? Maximum funding your 401k, and then that mega backdoor 401k as well. Third option goes right along with it, and that is an after-tax IRA contribution. Do you make too much money to make or can you make too much money to make an IRA contribution? No. You can make as much money as possible and still contribute to an IRA. You just need to have earned income. It can't just be investment income or pension income or Social Security income. You have to have earned income, and if so, you can contribute to an IRA. But it's possible you're going to make too much money to deduct that IRA contribution, and it's also possible you're going to make too much money to fund a Roth IRA. But if your income is above the thresholds to deduct that IRA or to make a Roth IRA, then you can make a contribution to that IRA, but after tax. You just don't deduct it. And then those dollars are then growing tax sheltered. And yes, the growth on those after-tax dollars would still be taxed out there in the future at ordinary income rates, but at least it's tax sheltered all along. The other opportunity that you'd have with these after-tax contributions is then you can convert them to a Roth IRA, and because those contributions were never deducted, you can convert that contribution amount to your Roth IRA with no tax consequence. Be aware you can't, if you have pre-tax money in that IRA, you can't just grab the after-tax portion and convert that. It's proportionate, so therefore you've got to be working with a CFP to make sure you do that correctly. Two more types of tax shelters that you can fund if you've got high income. This fourth one is your health savings account, HSA. There is no income limit to contributing to an HSA. That's right. Whether you earn $5,000 or whether you earn $500,000, you can still contribute to an HSA. Your eligibility is, do you have an HSA eligible, a tax qualifying, high deductible health plan? If you do, and that's the only health insurance that you have, then you can contribute to an HSA and deduct it up to the IRS limits that they allow each year, which is a few $1,000s, up to $10,000 if you're on a family plan and over age 55. But you can contribute to that HSA even if you've got high income, whether that's sort of permanent or just in one particular year or another. And then the final tax shelter that you could fund, no matter what your income is a 529 plan. I know the others have been more retirement focused, and that HSA, yes, I would say if you've got high income, I would treat that as a retirement type of account and do that shoeboxing, holding your receipts, done lots of videos on that before. But the 529 plan is more for college savings. Well, we can flip that on its head now with the Secure Act 2.0. You could consider a 529 plan as an extension of a retirement savings, but for your kids or for those grandkids. The other thing that I would tell you is if you've got high income, the odds of your child or grandchild getting a scholarship is probably less, right? And therefore, having dollars saved up in a 529 plan where you don't get a tax benefit, federal tax benefit on your contribution, but all of the activity is sheltered, and then you can use that growth towards college or qualifying college expenses and have it come out tax-free. That's an even bigger benefit because you have high income and because of our progressive tax system. So don't overlook the 529 plan. So those of you with high income, do you have to pay higher tax rates? Do you lose some credits and some deductions and potentially have to pay more taxes? Yes, that's what makes proactive tax planning all the more important, and taking a look at which tax shelters still apply even if you have high income and using them to the maximum benefit for your situation. Work with your certified financial planner, and if you don't have a CFP who's doing tax planning, working with your CPA, it's a must. You have to have them. So work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.